Hello, you traders. Today we'll be doing a market update. This is actually the third time because my colleagues already did one last 2 months ago and one again last month. So this will be the third market update for us. And first of all, I'm King de Mesa. I'm from Unicapital Securities, and I've been a research analyst for almost 2 years now. And currently, I'm handling property, telco, and gaming sectors. So let's start. Our agenda for today, of course, will briefly touch on the Philippine economy and the US market, and a chunk of our discussion will be focused on the local market, of course. So, first of all, on the macro side, as we know, the government imposed a lockdown to contain the spread of the coronavirus, and as a result, our GDP declined by 0.2%, um, mainly because of lower consumption. So this GDP decline was lower versus the median forecast of around 3% given by analysts and economists in the Philippines. And this decline broke uh, 8 years, um, 8 years of above 6% growth. As you can see in the graph, since 2012, we've been growing higher than 6%. And sadly, this is the first GDP decline since the fourth quarter of 1998, where our GDP declined by 3%. That's the time where Asian financial crisis is happening. And as you can see in the right side of the graph, household expenditure only grew by 0.2% versus last year's 6.2%. So this is very important because household expenditure consists of 70% of our GDP, and historically it's growing around 4 to 5%. And also, one driver of our economy for the past 10 years is the fixed investments or the capital formation. It declined by 18% during the first quarter of 2020. And this year is not really looking so good because of the coronavirus pandemic. Um, Several international institutions are forecasting GDP decline for 2020 for the Philippines. And actually, um, Fitch last 2 weeks ago or last 3 weeks ago um, downgraded the Philippine outlook from positive to stable. And we should not be surprised to see news coming in the coming weeks from other institutions saying that the Philippines um, economic outlook does not look so good for this year. And actually, the Philippine government forecast 2020 GDP growth at around negative 2% to negative 3.4%. So that's because of the economic disruption caused by the COVID-19, expectation of job losses, and of course, it entails falling incomes from households, and um, in effect, this will result in the deterioration of our economic and fiscal outlook for this year. For the BSP, as we know, the BSP for this year cut the benchmark rates by 125 bips and cut also the reserve requirement ratio by 200 bips. That's for this year alone. And the reason why they did that was to support the economy by encouraging lending. So effectively, this brought the borrowing costs to record lows. Our key rate right now is at 2.75%. This is compared to the 3% back in 2016-2017 levels where the BSP implemented the interest rate corridor policy. And going forward, analysts are expecting further rate cuts, at least 25 bips, and also reserve requirement ratio cuts. And in fact, the Monetary Board of the BSP authorized Governor Jokno to cut the RRR by up to 400 bips. So there still remains 200 bips to cut this year, um, as far as the authorization of the Monetary Board to Government Jokno is concerned. On the inflation side, inflation eased to 5-month low. It hit 2.2%. So that's partly good news. April inflation dropped mainly because of the global oil prices and weaker economic activity due to COVID-19. And last Friday, I think, the BSP issued a statement saying that the inflation forecast for the month of May should range around 1.9% to 2.7%. So that's likely to be higher versus April, but this is still subdued despite the recovery in global oil prices, the farm damage caused by Typhoon Ambo, and supply bottlenecks because of the lockdown in our country. And the subdued expectation for inflation is actually a good news, especially for the BSP, because it gives them some more room to cut rates to support the economy going forward. On the remittances, although remittances increased by 5% for the first 2 months of 2020, it is expected to fall significantly this year. So, just a background, our top sources for remittances this year are US, being the top one, followed by Singapore, Japan, Saudi Arabia, and UK. So the US being the top one accounted for around close to 40% of our remittances last year. And it's not going to be good also because of the coronavirus pandemic. Several institutions like Fitch expect a 2.5% decline in remittances, um, of course below or of course because of the job losses, falling income, and restricted deployment of new workers abroad. And in fact, BSP Governor Jokno also expects the remittances to fall between 0.2% to 0.8% this year. And lastly, the World Bank projected the remittance flows to fall by around 13% in lower and middle income countries, mainly because of layoffs and lower wages for the migrants around the world. And this is a significant factor mainly because it relates to consumption. It relates to consumption expenditure, and as I've said a while ago, it's very important because it accounts for 70% for GDP, and remittances in total account for around 10% for GDP. Meanwhile, tourist arrivals in the Philippines declined by 54% for the first 4 months of 2020, according to the Department of Tourism, mainly because there have been no visiting tourists because of international and domestic travel restrictions imposed by the government around mid-February of this year. And tourism is not going to be good also this year. The UN World Tourism Organization actually expects international visitor arrivals worldwide to decline by up to 78%. So that's a big decline relative to historical levels. And for the first 4 months of the year, the Philippines only recorded 1.3 million tourists uh, that came here in the Philippines versus last year's 2.8 million tourists. And for this year, the DOT has not given a revised forecast. But as far as I remember, they are targeting north of 8 million tourists for this year. That's their previous forecast, but they've not given yet a revised one. So now we go to the US market. As we know, during the first part of the year, it experienced a major decline, around 37% during February to March, mid of March. Of course, as we know, this is because of the surge in new cases in the US, and effectively, their government imposed a lockdown, causing a disruption in their economy. And some investors also fear of the second wave, even though or even though the US are now experiencing a slower decline in the or a slower increase in the new COVID cases daily. Some investors are foreseeing a second wave for the COVID-19. And also, um, there are recession fears. So, as we know, the US first quarter 2020 GDP declined by 5%. This is a higher decline versus the 3.5% expected by economists and analysts in the US. The driver of this decline is mainly due to consumption expenditure declining by 8%, and most of the analysts in the US are expecting the second quarter to be far worse because first quarter only included a few weeks of the economic shutdown. And we define so for a background and knowledge, we define a technical recession to have a country if their GDP declined by two consecutive quarters. So it's almost inevitable that a recession is coming for the US. But during the latter part of the year to date period, the US experienced 37% increase, mainly because of these reasons listed on the right side. Vaccine or treatment hopes. So there are some companies developing treatments or vaccines, including Novavax, and I think this is a Germany-based the remdesivir drug, also the Moderna treatment. And according to FunStrat, there are currently 10 vaccines in clinical evaluation and 114 in preclinical evaluation in the US. So some investors also became optimistic with regard to the to the reopening of the economy in the US because um, several states in the US like Georgia, Texas have already started to let some businesses, specifically non-essential businesses, to resume operations. And New York officials also have laid out a plan to gradually reopen the state for businesses. And some investors started bargain hunting as they see um, value plays from the major decline experienced in the first part of the year. The Philippine market is the same in terms of price movement decline. Looking at our index, it declined by 41% during January to March, but subsequently rebounded by 20%. Of course, what the investors were pricing in were the same. Of course, surge in new cases and the lockdown imposed by the government. And right now, we think that the market is biased on the downside mainly because of fears of the second wave of COVID-19, as the government is planning to reopen, or actually, they are reopening the economy. We are transitioning from MECQ and ECQ to now GCQ, despite continuously increasing COVID-19 cases. So that's the reason why we think the market is still biased on the downside. Also, there are recession fears. As I said, it's inevitable that we're going to have a recession as the first quarter declined, or as the first quarter GDP declined by 0.2%, and some Philippine economists are expecting double-digit decline during the second quarter of this year. And on the positive note, um, sentiment were also the same. We are trying to um, take cue from Wall Street as vaccine or treatment hopes, and we can only hope for other countries' development of a treatment or vaccine. Some are expecting an available one for the next 12 months or 18 months. And some investors also are becoming optimistic because of the reopening of the economy. Some are um, some are pricing in the reopening as a positive factor, but again, we think that the market is still biased on the downside than on the upside because COVID-19 cases here in the Philippines are continuously increasing day by day. And also, we think the investors are bargain hunting as the Philippine equities are at historical levels. And we're going to talk about that later on. Looking at our value turnover, it significantly declined. Our market's average daily value declined by around 40% for the month of May alone versus last year. So this is easily reflecting the decreasing appetite or declining appetite from our investors. One reason also was that net foreign selling was really huge on the year to date period. The foreigners or foreign investors are dumping their holdings as they remained net sellers as of May. So as you can see in the graph, May net foreign selling was around 10 billion pesos, and the total for the first 5 months from January to May is now around 50 to 60 billion net foreign selling. And we think that the market recovery will have a hard time. Of course, without the participation of foreign investors. So right now, we're going to compare our index in terms of year-to-date performance. So as you can see in the graph, we're actually the worst performing among the names listed here. We declined by 29% year-to-date. The highest performing were S&P 500 from the US and Shanghai from China. Also Japan, declining by 7.4%. For comparison in terms of valuation, the PSEi is trading relatively cheaper among these indices. Um, this is not a straightforward comparison, but of course, we want to get a perspective the where our market is in terms of price or in terms of valuation. So right now we are trading at close to 15 times compared to the US trading at 23, 24 times. So this is a very good graph to see really where our market is in terms of historical levels. So as you can see, we're currently at levels similar from 10 years ago, from the 2010 levels. And as you can see in the graph, we are at two standard deviations below our 10-year average PE. This simply means that we are at a very cheap level of the index. As you can see, there are some layman's term in terms of interpretation in the graph. It's colored yellow. So as you can see at the bottommost part, our index is at a very cheap level right now. And we think this is a very good time for long-term investors to accumulate quality companies at cheap prices because the risk reward is high at this point in time. And our consensus estimate is around decline of corporate earnings of 12%. this is higher in terms of earnings decline compared to consensus, which forecasts 7% decline for this year. And we expect the index to hit 6,000 levels by the end of this year. So really the main point in this graph is that historically we are at one of the most cheapest in terms of valuation, and we are at 10 year ago levels, and this is a very good time for investors, as I've said a while ago, to enter the market and hold stocks uh, for years to come. So now to give you a more specific um, list, which stocks are the cheapest. As you can see, the top performers as of the year-to-date period I've shown a while ago. Right now, it offers small and limited discounts, namely RHI, Pure Gold, Globe, and Tel. Mainly because the market has already priced in these companies will still perform good despite the coronavirus pandemic. And as you can also see, ICT and JFC offers limited discount because their earnings are expected to go down significantly this year. If you want to know what stocks are the cheapest, you look at the farther right side of the graph, since these offer a bigger discount to their respective price multiples. So the cheapest being LTG, GT Cup, and BPI. So you can practically choose which stocks you want to buy from these stocks listed on the farther right side of the graph. So it's a very simple graph showing you um, what stocks offer a discount and a premium already, and it gives you a perspective on which stocks could increase the quickest or the fastest when the coronavirus pandemic is not yet, or when the coronavirus pandemic is already not around here in the Philippines. Okay, so now we go to the strategy. These are simple but helpful strategies to implement. First one, of course, do not chase rallying stocks. As I've said a while ago, some stocks have already rallied as our market increased by 20% during the latter part of the year-to-date period. And some examples are TEL, Globe, and Pure Gold. So do not chase those rallying stocks. Wait for them to go down and have some cushion and higher risk reward when you try to enter the trade, or the when you try to enter into that stock. And also do not FOMO trade, as they say it. Second one, pick resilient sectors. We recommend telco and consumer retail. Um, but again, wait for the prices to go down. And we think one sector that has a high risk, high reward is banking sector, since it incredibly offers lower prices and really cheap prices relative to historical levels. Third one is to manage your risk. Of course, invest only for the long term. Do not trade the market if you are a long term investor. Invest in liquid stocks, for example, index stocks. We suggest you do not invest in speculative and relatively small companies. We suggest to stay invested in blue chip stocks. Um, Another one is diversify your portfolio. Do not overexpose on one stock or one sector only. Lastly, buy slowly at attractive prices. Once you see an attractive stock, we suggest not to allocate 100% of your capital in that stock. Again, diversify and do not buy 100% of that stock. And if you buy a stock, buy in tranches so that your risk is lower on the downside. In summary, of course, the coronavirus, as we've seen, took its first blow after the GDP declined by 0.2% in the first quarter of 2020. Second one, the US and Philippine markets continue to climb up slowly despite the negatives in the market. Third one, we think, in our view, the market's still on the downside with the economic and corporate earnings outlook. The market is very cheap relative to historical levels, presenting an opportunity for the long-term investors to position in sound and quality companies. And not last but not the least, risk management is key for us to avoid huge losses when the market goes against us. So that's all for the update, and stay tuned for more updates in the next weeks or so. Happy investing and thank you.